thinking about setting up a trust or managing one. Here's a big question trustees often face. Should you hold on to that trust income or pass it out to beneficiaries? The answer isn't always simple, and it can have a big impact on taxes and family planning. Hi, I'm Lauren Burns with SJF Law Group. Today we're breaking down what it means to accumulate trust income, why it matters, and when it might make sense. Don't worry, we'll keep it simple. What does accumulating trust income mean? Let's start with the basics. A trust can earn income, such as interest, dividends, or rent. Now, the trustee has a choice. They can either distribute that income to beneficiaries or keep it inside the trust, which is called accumulation. When income is accumulated, it gets added to the trust's principal. Here's where things get tricky. Trusts don't get the same generous tax brackets individuals do. In 2025, a trust hits the highest federal tax rate, 37%, at just about $15,650 of income. Compare that to individuals where you don't hit 37% until over $600,000. Big difference, right? Let's look at an example. If a trust earns $20,000 and the trustee keeps it inside the trust, most of that could be taxed at 37%. That's roughly $7,400 in tax. But if the trustee distributes that income to a beneficiary in, say, the 22% tax bracket, the tax would be closer to $4,400. That's a $3,000 difference. So why would anyone accumulate income? Good question. Sometimes it actually makes sense. For example, if the beneficiary is a minor and isn't ready to handle the money. If you're protecting assets from creditors or from a beneficiary struggling with things like gambling or addiction. Or if you're trying to preserve eligibility for government benefits, like in special needs planning. So yes, taxes are higher, but protecting the bigger picture can be worth it. Trustees aren't always stuck choosing all or nothing. They can make partial distributions, mix and match strategies, or use provisions that let income flow directly through to beneficiaries in a more tax-friendly way. Accumulating trust income isn't automatically good or bad. It depends on your goals, your beneficiaries, and the type of trust. What's most important is that trustees don't make these decisions alone. Work with an experienced estate planning attorney and a tax advisor so you don't accidentally cost your family thousands in taxes. If you found this video helpful, please give it a thumbs up. Also, don't forget to subscribe to our channel to stay notified whenever we add a new video. Thank you for watching today.